I think now that it's inevitable that precious metals will do well. I say it's inevitable for reasons that you and I have discussed ad nauseum over the last 3 years. Precious metals do well when people are concerned about the purchasing power of their savings denominated in fiat. And anybody who isn't concerned about the maintenance of their purchasing power is both illiterate and innumerate.
Rick Rule emphasizes the inevitability of precious metals performing well, attributing it to concerns about fiat currency's purchasing power. He critiques the Consumer Price Index, CPI, as an inadequate measure of inflation, highlighting its exclusions. He argues that including government expenses in the cost of living reveals a 7% annual decline in purchasing power. Rule advocates for gold and silver investment, citing historical bull markets as evidence of their portfolio protection benefits, urging viewers to allocate 5 to 10% of their portfolio to precious metals for genuine insurance against economic uncertainties. Let's dive into the video to hear his full thesis.
We've talked about the subdivisions of concern before. Quantitative easing, which is really counterfeiting, debt and deficits, negative real interest rates, inflation. There are some people who are less concerned about inflation because they follow the CPI, the Consumer Price Index. And I want to disabuse them of that right now. The CPI is not a measure of the depreciation of the purchasing power of your savings. It's a constructed index, constructed by the big thinkers, hedonistically adjusted, which means they decide what an apartment is worth or what a computer's worth. They don't let the market decide. Too inconvenient for them. It doesn't, when it's inconvenient, include food or fuel. I like to drive. But most importantly, it doesn't include tax. Anybody who shops where I shop and buys the basket of goods and services that I consume will understand that tax is the largest household expense of working American families. And a cost of living that doesn't include government isn't a cost of living. I would submit to your viewers, before I answer the rest of the question, that the basket of goods and services that they consume, including government, willingly or unwillingly, means that their purchasing power is declining at 7% compounded. The anti-gold, if you will, is the U.S. 10-year Treasury, a fiat-denominated savings instrument. So here's the arithmetic. Your government, the U.S. government, promises to pay you, I think it's 4.26%, and they will, every year for 10 years, in a currency where the purchasing power is declining by 7% and probably increasing. In other words, the government absolutely positively guarantees that they'll cost you, 276 basis points, 2.75% of your purchasing power every year for 10 years. The first promise our government has made me that I unequivocally believe that they will deliver. So, with that long introduction, it staggers me that people aren't more willing or more eager to invest in gold or silver. Previous gold bull markets have shown that a relatively small amount of insurance by way of gold or silver can generate large coverage, protecting your portfolio. In the decade of the 70s, the last time that we faced the recipe, the sort of menu of problems that we face today, the gold price went from an admittedly price-controlled $35 all the way to $850. A little bit of gold sheltered a lot of damage to the rest of your portfolio, probably more meaningfully. The last real gold bull market we had, 2000 to 2011, the gold price went from $256, I think, to $1,850. Pretty good move, sevenfold move, maybe more. The point of this is that people who don't have somewhere between 5 and 10% of their portfolio in precious metals are going into a circumstance with absolutely no portfolio insurance, with the need for real portfolio insurance.
In this next discussion, Rick Rule advocates for diversifying beyond physical gold and silver by considering investments in gold and silver mining stocks. He suggests owning major companies for market beta, citing potential gains of 300 to 400% with low company risk during gold market movements. While emphasizing the importance of prudent investing, he encourages some speculation with junior mining stocks after securing beta. Rule draws from his experience in past bull markets, highlighting how a small allocation to precious metals can safeguard purchasing power. He expresses disbelief that the market share of precious metals in the U.S. is less than 0.5%, projecting a quadrupling in demand as precious metals regain their historical mean market share of 2%. Rule underscores the rare but dramatic nature of gold price movements, urging viewers to position themselves to benefit from this potential move.
Beyond owning physical gold and silver, A as liquidity and B as insurance, people need to consider owning the gold and silver mining stocks. I'm going to argue that most people should own 3 or 4 of the great big ones, which is to say buy market beta. Because when the gold stock market moves, the biggest and best companies in the universe can give you 300 or 400% gains with very, very, very little company risk. For people who are dealing to do more work and take more risk, absolutely, positively, buy the juniors, a well-constructed group of juniors. I joke because all of the money now I invest prudently, I made by speculating wildly. I'm not saying don't speculate. I'm saying invest first. Own the beta before you seek the alpha. I think it's very important to do that. I have now been through 2 major bull markets in gold and 3 small bull markets in gold. And as I say, the reference market that I have for the bullion, which is the decade of the 2000s, the gold price increased, as I say, from $253, $255 to $1,850 an ounce. A little bit of portfolio insurance salvaged your purchasing power from what could happen in other sectors, and it did it very well. It's very difficult for me to understand why people wouldn't do this. I'm not suggesting that people put 100% of their net worth in penny silver stocks. That's not what I'm saying. Your listeners will be shocked to learn that the market share of precious metals and precious metal securities in the U.S. market is less than 0.5%, which is to say, less than 0.5% of all savings and investment assets in the United States are precious metals related. The 4-decade mean market share of precious metals is 2%. I believe that at a minimum, precious metals will regain their 4-decade mean market share, which means that demand for precious metals related investments, gold, silver, gold stocks, silver stocks, that type of thing, demand for those will quadruple. That's precisely what I think is going to happen. And if you look at the moves in the XAU, if you look at the moves in gold price over time, what you'll see is that when they occur, and they're rare, they are absolutely dramatic. The idea that somebody wouldn't want to put themselves in the way of this move is incomprehensible to me.
Today, we delved into the insightful perspectives of Rick Rule, highlighting the inevitability of precious metals thriving in the current economic landscape. Rick stressed the importance of safeguarding your purchasing power amidst concerns like inflation and depreciating fiat currency. He passionately advocated for not just owning physical gold and silver for liquidity and insurance, but also considering the potential benefits of gold and silver mining stocks. Rick recommended a balanced approach, emphasizing market beta with major companies and allowing room for speculation with carefully selected junior mining stocks. As we wrap up today's discussion, keep in mind Rick's call to action, allocating 5 to 10% of your portfolio to precious metals. The historical performance of gold during bull markets underscores its role as a powerful portfolio insurance. If you found this information valuable, don't forget to subscribe, like this video, and share your thoughts in the comments below.